This is AstroFX and welcome back to that all-important Technical Tuesdays.
We are now on Technical Tuesdays volume 45. That's right, over 45 hours of free technical content stretching back over 2.5 years. The last video, the first video of January 2017, had an epic response, and we're now touching base over 33,000 subscribers on YouTube. Thank you.
That's right, so each video that we bring to you guys, you know the routine. We bring an important talking point or a trending topic to you, explain it, break it down, and then we follow it with the all-important technicals. And it's the same this week. We've got an important subject of key levels, which we know is vital for you guys to understand.
Cool, so that's going to be going through more of the theory side. I'm going to be showing you practically on the charts, so let's get started.
Let's go. So guys, if this is your first time watching Technical Tuesdays, just to give you a quick breakdown of what we like to do. Firstly, we like to use this whiteboard to break down and give you a deeper understanding to our talking points, and then I'll pass it up to Sean, and we like to bring up a live chart example and also help you understand it technically. So here behind me are some rules that I wrote down for the importance and rules of key levels. Let's go through number one. Number one, must be a significant level. And here in brackets, I've written major and minor. And one of the biggest mistakes I've seen is that people do not understand there is a hierarchy when it comes to key levels. There will be hierarchy when it comes to a monthly key level compared to a 5-minute key level. There will be a major and a minor key level. So do not think that all key levels that you'll place will have the same significance in that currency pair. I'm going to pass it over to Sean, hopefully on Euro USD, so he can show you that example.
This video is me going to be showing you and taking you through the rights and wrongs of just some basic principles of support and resistance. The chart I have right in front of me here is the Euro USD 4-hour time frame. Very, very clean, precise, straightforward. So in terms of support and resistance, how do I plot it on? Number one, on this time frame in particular, I am looking for the points in which the market has hit numerous times, but I'm also looking at the wicks primarily as well. So over here, I can maybe go, okay, 1, 2, so that's support, we broke through it, retested back and broke through as resistance, and then we've retested it as support once here again. So that's quite a significant level over there. Another one of significance could potentially be just here. So I've gone from the top of this wick and I've snapped the horizontal line tool right on there. And as you can see, resistance, 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 and so off. And now we are looking at that being a support level. Okay. One that I had on earlier, which was just here, so we have 0.1, 0.2 over there as well. This one could maybe modify. Now another tip as well when you're doing support and resistance, you can always just go back onto the left of the chart and use as much data as possible. So I could maybe even bring this one all the way back over to here, and now we have more or less 3 points, 1, 2, 3. So that's just the general basic idea and ideology behind plotting support and resistance on the 4-hour time frame.
So I hope you guys understood that really well. Let's move on to rule number 2. Rule number 2 is each time frame has its own levels. So in brackets here, I've written the monthly, weekly, daily, 4-hour, 2-hour, and 1-hour. Now that's just our preference, and you guys as your own individual traders could be using your own time frames. But please ensure that you do not use a monthly key level and try and use it on a 1-minute time frame or a 5-minute time frame. You've got to understand the difference of using a particular time frame to do your major analysis on, and then maybe a different time frame to do your execution on. So that will be different key levels. And again, I'm going to pass it to Sean so he can show you the difference of hopefully a monthly key level, a weekly, and then maybe a slightly lower time frame.
Okay, each time frame has its own levels, yes. Every single currency pair, if you treat it from the top-down perspective, there will always be certain rules that need to be applied in order to get the most accurate and convenient levels going forward. So I always personally start on a monthly time frame. I'm sure you guys are familiar with my charts anyway. But yeah, Euro USD, as you can see on this monthly time frame, there's so much going on over here onto the left. It's not really too relevant yet. I don't really care where Euro USD is going to end up in 2 years' time. I want to keep it short, sweet, and relevant. Now, if I look at the monthly time frame recently, my main monthly ones are the ones with the strip across, so 1.0500 and 1.1450. I use a specific method and calculation to actually get these, and I don't have to come every single day and start drawing these on. So when you're using monthly and weekly and maybe even daily levels as well, it's not every single day you have to open your charts and start to modify your analysis. Monthly are generally the strongest. And again, I'm using a similar technique to what I did on the 4-hour time frame in order to actually achieve these levels. So we have the monthly, I have my weeklies over here as well, labeled nice and accurate. And then I also have the rays here as well, which I've demonstrated in the last segment, which come from the daily and the 4-hour time frame and so forth. So if I just go to the weekly, if you look at the weekly now, Euro USD quickly has breached 1.0500, but as you can see here on the weekly time frame, we had 1, 2, 3, 4, 5 spikes below. There wasn't a full body close, which tells me that the momentum wasn't strong enough to sustain below that level. And as you can see here, it's whipped all the way back up. So that 1.0500 has been relevant for nearly 2 to 2.5 years now on the Euro USD. So that's just a quick example there of how I lay my monthly, weekly, daily / 4-hour key levels out.
So again, guys, I hope that helped you, and hopefully you're taking down notes as we go by. So number 3 is support and resistance is just not one price. Now, this is something which I'm talking from personal experience here, and I'm talking 1.5 to 2 years of getting this very wrong. Now, when trying to trade, doesn't matter what time frame, I used to be under the impression that as soon as the price approaches one key level or one round number, that's my key level. And then certainly with a little bit of market manipulation, I'll be stopped out of a trade, or I'll see some consolidation at that key level, and I wouldn't really know what to do. I wouldn't know whether to wait, whether it would be a fake out or a breakout. And after a lot of experience, I understood that that key level is actually a zone. Now that zone could be a range between 15 to 25 pips. Each zone could be different, but understand a key level is just not one price. So understand it's maybe a good idea to draw a zone on there, and I'll get Sean to show you what that zone should look like right now.
Okay, now we are going to go through the support and resistance not being just one price point or price area in particular. So going back to the first example on the Euro USD 4-hour time frame, what I've seen here was obviously this level at the top. It's not as accurate as I can make it. So we have that area there. Another one could be maybe just over here. Okay, so what I've more or less done there, I've made a zone. So the zone we have from the top wick across there 1.0815, and then the secondary one I've tried to line up just through here onto here as well. So we can see the spikes have gone through it, but the body of the candles closed below. And as you can see, late last night, Monday, you can see Euro USD actually came right back up to that level. Now what I would do here in particular, instead of having various lines drawn on and so on, this is a zone for me. So what I can do, I can get the rectangle tool and I can more or less color in that zone. So that's that zone right there, and it's completely up to me now, or you guys, if you want to go ahead and just delete those horizontal rays. So this zone for me, we can see maybe a sell opportunity on the Euro USD, because as you can see from point 1 over here, we've seen quite a lot of momentum to the downside. It revisited that zone again, momentum to the downside, and then once more today it's come back into that zone. Can we see more momentum as we did in the prior 2 examples? Who knows? Just one last piece of advice here is that the zone, sometimes the market can come close to the zone, in the middle of the zone, or maybe even at the top of the zone as well. So a tip would be always wait for a confirmed reversal point, more or less on a 4-hour, even a daily time frame before actually going short in this case.
So rule number 4. Rule number 4 is higher time frames, the better. And in brackets I've put no 1-minute time frame. Now, everyone watching this video could have their own strategies. There's loads of different traders, and they will all trade in different manners and styles, which we appreciate. However, when it comes to key levels, remember that hierarchy I talked about, and I believe it was rule number 1, which is the higher time frames, the more significant. So if you want to go down to a 1-minute or 5-minute time frame and try and draw those key levels, you're going to drive yourself absolutely insane. And chances are your key levels are going to be absolutely everywhere. So try and stick to what we would recommend, maybe the hourly time frame and above when it comes to those key levels.
Now on to the next one. Comparing 1-minute, 5-minute, 15-minute time frames to more or less what I showed you, the weekly, the monthly, the daily, and so forth. All right, so again, back to this example here. As you can see, kind of keeping it clean, very, very precise. So if I compare this 4-hour time frame to a 1-minute time frame, let's have a look. So I haven't even got the 1 minute up. Let me just get the 1 minute up. 1 minute. Okay, so 1 minute. Every single candlestick or every single bar represents 1 minute of price action. Now, if we zoom right out, we can actually see the 4-hour levels are still on my chart, and they look miles away. You look absolutely miles away here. But what I used to do back when I was first learning, and what people still do now, is this. They'll go into a 1-minute time frame, 5-minute time frame, and start plotting support and resistance. And just to show you how insane it can get, let's just have a little go. So, horizontal ray tool once more, or we could maybe place one here. There's maybe one over here, maybe even all the way back from there. We could maybe go from across here, and we can go maybe here. A couple more, one there, and maybe even one there as well. So we've got 1, 2, 3, 4, 5, 6 levels on the hourly on the 1-minute time frame. Sorry, but if you look at the pip difference in between each one, we've got 25 to 33, looking at 8 pips. 33 to 41, you're looking at another 8 pips. 41 to 49, 8 pips. I didn't actually do that on purpose. They're all coming in at 8 pips. But yeah, you get what I mean. 8 pips in between. It's not really sufficient in order to get nice risk-reward trades and so forth, and it's a big mess. So you'll be like, okay, it's at resistance now, sell, buy, it's all over the place. But one thing people don't actually take into consideration, and I was one of those, when you are looking at very, very small time frames with no structure, you can often hit a trade on the wrong side of the trend direction. So you have to really read the higher time frame analysis, the overall trend, the bigger key levels, to even gain an edge on these smaller time frames. It's something that we do not recommend to anybody, and it's a very, very stressful trading overall.
The last rule I'm going to go through before I pass it over to Sean and we move on to some of the myths and advice. Rule number 5 is roll, reversal, ceiling and floor. Now, if you're completely new to the concept of support and resistance, this would be a really easy way for you to digest what exactly support and resistance is. So, imagine support is your floor and resistance is your ceiling. Now, if you were to break below this floor, that previous floor becomes your ceiling. So that becomes your resistance from then on, and then you'll have to search for a new floor / new support. Now, this will be easier for Sean to explain, but try and use the concept of floor and ceiling when it comes to that price action and trying to draw on those key levels.
The higher time frames are in fact the better ones, and how to balance out the floors and ceilings within your support and resistance structure. If we go back to this 4-hour time frame, I've still got my mini 1-minute levels on there. Look how stupid they look in the grand scheme of things. Now, if I can just remove a few of these floors and ceilings, so more or less the zone I've already drawn on there on the euro is in fact a ceiling right now. You can clearly see that it's having issues in coming past this zone. The zone specifics to the price is 1.0803, so the round number has quite a significant wait. Let me do that. Oh, fuck. Motherfucker.
15 minutes can flow.
Now, on to the next one. The higher time frames, yes, they do hold the most reliability. And let's go through the floors and ceilings of support and resistance. Now, the higher time frames are a lot easier to actually comprehend and understand on a practical level how this works. But let's just go back to this chart here. So the 4-hour time frame, as you can see, top right, they're all the 1 minutes I just drew on. And look how stupid they look in the grand scheme of things. So what I'm going to do, I'm going to actually remove all of these right now. And then I'm just going to show you guys an example of a ceiling. So a ceiling and a floor. The most recent ceiling on the Euro USD is around 1.0800, but as I've said, it's more or less a range. So the market will repeat history, but it may do it in just a slightly different manner. So ceiling, 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 ceiling. Now, two things Euro USD can do here. This 1.0684 is actually acting as the floor right now, and 1.0800, our range, is the ceiling. What can often happen is, boom, we recently broke through the ceiling, which is now our support. So this can often happen. You just bear with me. 1, 2, 3, 4. So we can retest that zone as a floor and maybe even break through this ceiling over here as well, because I'm taking the higher highs and higher lows into consideration here. So Euro USD on the 4-hour time frame is giving us signs that it's actually in a bullish medium-term trend. So once it's actually broke above that ceiling, it can repeat the same pattern where it retests it, once more as a floor, and off into new highs. Simple.
So there will be more rules when it comes to support resistance, and of course every trader will have their own custom rules, but they were the 5 top rules which we thought would be brilliant for you guys to note down and introduce into your trading. Now next, we're going to be talking about some myths. Now of course, we've been teaching for nearly 3 years now, and over those 3 years we've heard all sorts of stories, good, bad, and definitely some rules of support and resistance which we definitely will include as myths. So we've kind of got the top 3 that we've heard. I'm going to break them down right now. So number 1, more the better. Now we have seen all types of charts, and we've seen 5-minute time frames, 1-minute time frames with over 50 key levels. We've heard stories where people make up strategies where if they draw more key levels on, they can enter multiple trades, they can try and scale in and scale out. It's absolutely a mess. So I'm going to get Sean to show you an example of what we mean by this myth of the more the better.
Myth number 1, the more key levels you have on the chart, the better it is. Now let's just debunk that myth. So firstly, over here we have the Aussie on the hourly time frame. So what I've seen personally from individual students actually who've came into our office and showed us some of their analytical skills is something like this. So I'll go through the basis of support and resistance, and I've seen people actually go through a chart and place so many key levels of support and resistance on, it becomes an absolute nightmare. And it's another form of analysis paralysis overall. So they'll go from every low, every high, and just draw a level everywhere they can maybe even spot one on the chart. And as you can see, ignore the labels on the right hand side here, they are getting relatively messy. So the downside and downfall of actually doing this is that sometimes when you're trying to hold a trade for as long as possible to milk as many pips as possible, then it can often run into one of these levels. Let's say you had like 50 levels on the chart, it can run into level after level after level after level, and it's going to cause a lot of anxiety in your trading. You're not going to know when to get out. You might be wanting to get out at one level and then buy off the level, and vice versa. So what we need to do is just provide structure into all of the analysis, again, like the Euro USD chart I showed you earlier on, and adding as many points of support and resistance onto a chart, especially on the lower time frames, is an absolute no-no. It's just you're going to go in circles and you're going to drive yourself absolutely insane.
That's right, guys. Now, when it comes to the next 2 myths, I'm actually going to bring them together and talk about them at the same time. So the first one is trying to scalp these levels, and the next one is not letting the trade breathe. Now again, this is definitely a mistake and a bad habit in which you've seen a lot of traders, especially the ones that think key level is one price. Now, when trying to scalp these levels, people will try and definitely be very aggressive when it comes to the market, and often try and use a stop loss, somewhere in the range of 5, 10, 15, 20 pips. Now, time and time again, they're going to be losing more trades, they're going to be getting stopped out, and they're trying to be very aggressive, but their overall trading is not going to be very consistent or very planned out or thorough. So what we're going to show right now is a bit of market manipulation, that if you're going to try and scalp off support and resistance levels, how you're most likely going to get stopped out most of the time. Thank you, Sean.
Now the next one, trying to scalp from the higher time frame levels. Now with the weekly, monthly, and sometimes even the daily key levels, a lot of people will often try to do higher lot sizes and very, very small stops around these zones. And I just said zones because that's what they are in a higher time frame. So just remember that if you're trying to trade directly from one of these levels with a really, really small stop loss, when the zone's probably the same amount of that stop loss, 20, 30, even 40 pips, it's not going to go too well, because we can maybe even consolidate for a while before reacting from that level. So the best thing to do is, if you're using the weeklies, the monthlies, the dailies, the time frame that I would suggest to you guys is using a 4-hour time frame and a daily time frame to look for reversals from your monthly, weekly, and daily key zones. So you want to allow the trade to breathe. You want to use stops at least 60, 70 pips going forward, and just ensure that your money management is in place as well.
So before we let you guys go, we do hope you've been taking notes throughout the course of this video. And if you haven't, I'm going to leave you with the 3 pieces of advice regarding support and resistance that you guys can take away and introduce you to your trading. Number 1, keep it simple. Now guys, you could do 10 different courses, have 6 different indicators, use 2 different robots, and try and trade in a group of 100 people. This will not mean that your trading will be any better or profitable. Keep it simple. This is talking from a lot of experience in which we had to keep going back to the drawing board and taking things away from our trading. Trade smart, not often is a quote which all of you traders should consider. Keep your chart simple as well, and all those important key levels. Number 2, create rules to your trading. Now, a lot of traders will wake up every single day and try something different every day. They'll come back to the charts with no plan. They'll just basically try and wing their trading. So definitely set some rules out. You can write those rules down, put it on your wall, put it on your desktop, get a sticky pad, but definitely have some sort of notes in which you're going to do this firstly, followed by this, and this is your plan for execution. Have a plan. Number 3, always back test. Now, this could be your strategies and your key levels. Now, I'm going to show you a good example of how these key levels are so important in our trading. Some of the key levels that we use currently in this present time were the exact same key levels which were causing a problem nearly 10, 15 years ago. And so all of you guys have access to this. If you take the time out, go onto your trading platform and again, write down these key levels, back test them, go back in time, see how relevant they were, see what trading patterns you saw, and try and use them for your future trading. So that's some advice for you guys. There's some myths, and there are 5 important rules of support and resistance. I'll pass to Sean, and I hope you guys enjoy this episode of Technical Tuesdays.
Okay, so points of advice. Now, firstly, I've already advised you on how to keep your levels as clean as possible going forward. You've seen how I do the layouts on the 4-hour, using the zones and so on, and not to go down to the 1 minute, 5 minute, and even 15-minute time frames. Number 2 is create rules. So I have my own rule-based system, what to do on the monthly, what to do on the weekly, what to do on the daily, and I don't move to the weekly and the daily if the monthly are not complete. All of those rules are given to every single AstroFX student, and they're also in the book that we provide. So set your own rules and maybe stick them on your wall so you can keep to these rules every single day. Last but not least is always back test. So going back in time, let me just show you a quick example on the GBP USD. If we look at this area, early 2009, and we can just simply mark this on. So that level there was 1.3500. GBP USD recently, most recently actually, made lows of around 1.1913, 1.1914, and more or less that was a 31 to 32 year low. But the marking I've just put on right here, 2009, you can clearly see where we broke through that after Brexit. We retested it as resistance and onto new lows. So again, I have all my levels on for GBP USD, and I'm not going to have to change them for a very, very long time now. So that's our Technical Tuesday, volume 45 done on key levels. I hope that provided something of value to you guys out there, all subscribers and so on. Now, all the key levels that you've seen on my charts, just as a word of advice, I've had them on for years. I've been watching these currency pairs and living them out on a day-to-day basis for a good amount of years now, and I'm quite proficient with my key levels and I work with them day in, day out. So a word of advice is that the more chart time you put in, the more you study these key levels and study your individual currency pairs, the key level structure overall will eventually all sink into yourself. So I hope you enjoyed the video, and we're going to see you in 2 weeks' time.